Bed Bath & Beyond was once one of the strongest home goods retail chains in the United States. Its annual sales were approaching $12 billion, and at its peak, its stock price had climbed to nearly $80. But in April of 2023, the company filed for bankruptcy protection and began closing its stores and liquidating its operations. The common explanation is simple. Amazon dominated e-commerce. Customers stopped visiting big box stores. Discount coupons weakened profit margins. And then came the pandemic, followed by supply chain disruptions. All of that is partly true. But there is another number, a number that reveals a very different side of the story. Over less than 2 decades, Bed Bath & Beyond spent nearly $11.7 billion buying back its own shares from the market. Then, when the real crisis began and the company could no longer buy enough merchandise to fill its stores, only a very small fraction of that money remained. So, how did one of America's most successful retail chains become a company that did not have enough liquidity to fill its own shelves? And how did the share buyback machine help accelerate its collapse? To understand that, we need to go back to the period when Bed Bath & Beyond seemed impossible to bring down. The company did not sell just one product. Its stores were enormous and filled with thousands of household products. Towels, kitchen tools, curtains, furnishings, coffee machines, storage products, and almost everything a home might need. A customer could enter the store to buy one simple item, then leave with a cart full of things they had never planned to purchase. The company helped create this habit through its most famous marketing tool, the 20% discount coupon. These coupons arrived at people's homes through the mail. Customers kept them in their cars or inside their bags until it was time to shop. Over time, many consumers began refusing to buy from Bed Bath & Beyond at full price. But during the company's strongest years, this was not a major problem. The stores were crowded, sales were high, and the company was generating strong profits. In the middle of the previous decade, annual sales were approaching $12 billion. The group operated more than 1,500 stores under several different brands, including Bed Bath & Beyond, Buyback Baby, and World Market. The company generated enormous amounts of cash every year. And that raised the question every mature and successful company eventually faces. What should it do with all that money? It could use the money to modernize its stores. It could build a stronger e-commerce network. It could improve its warehouses and inventory systems. Or it could keep a larger portion of the cash to protect itself against a sudden change in the market. But Bed Bath & Beyond chose to direct a huge portion of its money toward something else. Buying back its own shares. The number of shares in circulation falls, and if profits remain unchanged, the earnings attributed to each remaining share rise. This can improve financial metrics and give existing investors a larger ownership stake in the business. But there is a problem. The shares a company buys can be canceled, but the money paid for them does not come back. Bed Bath & Beyond began large-scale share buyback programs in 2004. Over the years, it bought hundreds of millions of its own shares at a total cost approaching $11.7 billion. At first, the strategy appeared logical, but the decision became far more dangerous in 2014. That year, the company borrowed about $1.5 billion by issuing long-term bonds. In just 1 year, Bed Bath & Beyond spent nearly $2.25 billion buying its own stock from the market. In other words, the company was no longer using only its excess profits. It had begun adding long-term debt. For investors, the move was attractive. The share count falls, earnings per share rise, and demand for the stock increases because the company itself is buying it. But for the company, there was another side to the transaction. A share buyback program can be stopped at any moment. Interest payments on debt cannot. They must still be paid even when sales decline. Over the following 3 years, it spent nearly $3.9 billion buying back shares. And this was happening while the retail industry was beginning to change. Amazon was expanding rapidly into home goods. Walmart and Target were improving their e-commerce operations and their delivery services. Wayfair was making it easier to buy furniture and home decor online. New brands were also beginning to sell directly to consumers without needing thousands of large physical stores. But an enormous store also means high rent, a large workforce, massive inventory, and operating costs that do not disappear when the number of customers declines. The company needed a rapid transformation. It needed to connect its stores to its website, improve inventory management, accelerate delivery, and understand more accurately what customers actually wanted. In 2014, it planned to spend less than approximately $400 million on capital expenditures and business modernization. In the same year, it spent more than $2.2 billion buying back shares. That does not mean spending billions on technology would have guaranteed success, but Bed Bath & Beyond was using the largest portion of its money to improve the appearance of its financial numbers. At first, the danger was difficult to see. Sales were still enormous. The company could still pay its interest. But profit margins began to decline. Customers became increasingly dependent on discounts. Some stores began to look outdated compared with their competitors. And consumers could now compare prices and order products from their phones within minutes. Having thousands of products inside one store was beginning to turn into a burden. If the company selected the wrong products, its money became trapped inside inventory that customers did not want. In 2019, pressure on management increased, and Mark Tritton took control of the company. Tritton came from Target and arrived with a new plan to transform Bed Bath & Beyond. He wanted to close weak stores, modernize existing locations. He also wanted to develop the company's private label brands. Then, the coronavirus pandemic arrived. Stores temporarily closed, but people began spending more money on their homes. Online sales improved, and the company sold several assets, raising a significant amount of liquidity. By the beginning of 2021, Bed Bath & Beyond had approximately $1.35 billion in cash. Bed Bath & Beyond decided to accelerate a $1 billion share buyback program and complete it ahead of schedule. During fiscal year 2021 alone, the company spent nearly $575 million buying back shares. Annual sales fell from approximately $9.2 billion to around $7.9 billion. The company recorded an operating loss of more than $400 million. By the end of the year, liquidity had fallen from approximately $1.35 billion to less than $440 million. A large portion of that decline came from share buybacks, and this is where the nature of the problem changed. During the strong years, Bed Bath & Beyond, it was buying shares while sales were falling and losses were rising. The company was spending the liquidity it needed to rescue its operations in order to show confidence to investors and support the stock price. But a store does not operate on its stock price. A store needs merchandise, and merchandise must be purchased before it can be sold. Employees must be paid, transportation costs must be covered, and supplier bills must be settled. Most importantly, suppliers must trust that the company will pay them later. When supplier confidence begins to weaken, the terms of business change. Instead of sending merchandise now and waiting several weeks for payment, a supplier may demand payment in advance. This places the company inside a dangerous cycle. Bed Bath & Beyond needs merchandise to generate sales. This cycle began to appear clearly during 2022. The company was losing hundreds of millions of dollars. Suppliers began tightening payment terms and reducing the credit they extended to the company. As a result, fewer products arrived at the stores. Customers began entering branches, but they could not find the products they were looking for. Some shelves were nearly empty. And when shelves are empty, sales fall. When sales fall, liquidity declines. When liquidity declines, buying inventory becomes more difficult, and the shelves become even emptier. This was the moment when the financial problem became visible to customers. Customers knew nothing about these share buyback programs. They did not know the company had borrowed money years earlier to buy its own stock. But they could see an empty shelf, and then they could go to another store or order the product online. At the same time, the private label strategy was creating new problems. The company reduced several well-known national brands and replaced them with its own private brands. But many customers did not enter Bed Bath & Beyond looking for an unfamiliar product. They wanted the brands they had always purchased. These mistakes could have been corrected, but all of that required two things: time and money. Bed Bath & Beyond was losing both. By late 2022, liquidity had fallen to just over $200 million. And by the beginning of 2023, only tens of millions of dollars in cash remained, while annual losses were measured in the billions. The company had historically spent approximately $11.7 billion buying back its shares. Then it reached a point where it no longer had enough money to fill its stores with merchandise. Of course, it would not have been possible to keep all that money in a bank account for 20 years. But Bed Bath & Beyond did not need to retain the entire amount. It only needed a larger portion of that liquidity when suppliers lost confidence. It needed money to buy the right inventory, to bring back the products customers wanted. In August of 2022, the company announced an emergency plan. It decided to close approximately 150 stores, reduce jobs, cut costs, and attempt to raise new financing. Then, it began issuing new shares to obtain liquidity. And this revealed one of the strangest ironies in the entire story. Only months earlier, the company had been using its money to buy shares from investors. Now, after the share price had fallen and the crisis had intensified, it was trying to sell new shares to those same investors. In other words, Bed Bath & Beyond bought its own stock when the price was higher and liquidity was available. Then it tried to sell stock when the price was lower and the company desperately needed money. On April 23, 2023, Bed Bath & Beyond filed for bankruptcy protection. The company began closing its stores and liquidating its inventory. And the retail chain that had once been one of America's most famous home shopping destinations came to an end. It is easy to say that Amazon killed Bed Bath & Beyond. It is easy to blame the coupons, the outdated stores, or the private label strategy. The real problem was how it used its money during the years of strength. The company spent billions of dollars reducing the number of its shares. That made the financial metrics look better. But it did not make the stores stronger, and it did not give suppliers greater confidence. Bed Bath & Beyond collapsed because it entered a period of decline after spending a huge portion of its financial protection. When the losses began, it no longer had enough time to correct its mistakes. When suppliers lost confidence, it no longer had enough liquidity to fill the shelves. And when it tried to raise money from the stock market, the share price had already collapsed. The lesson is not that share buybacks are always bad. The lesson is that current profits do not guarantee future profits. And when a company operating in a rapidly changing market uses debt and enormous amounts of liquidity to buy back its own shares, it is betting that the years of success will continue. Bed Bath & Beyond lost that bet. It spent billions of dollars buying pieces of itself. Then, when it needed money to save itself, it could not find enough.